All right, good morning, everybody.
Good morning.
Good morning.
Any questions before we jump into our discussion today? All right, so I just want to wrap up on Chapter 5, legal liability. Then we're going to start into Chapter 6, which is audit responsibility and objectives. So I think we've covered most of the key points here. I mean, we have to understand that, like all of society, CPAs and auditors live in a litigious environment in the United States. It's just a function of our daily life. So we have to be aware of where the risks are and how to mitigate those risks. So, and certainly when it comes to auditing, one of the big risks is negligence, and negligence can either be ordinary negligence or gross negligence. And ordinary negligence happens on occasion, and the best thing we can do when we make a mistake is to find it, admit it, and then do the best we can to correct it. But I think having things like malpractice insurance, legal liability insurance is an essential thing for any professional, because we're in a very complex environment, and we know that things can happen even when we follow due diligence. And the other risk we run is that people may sue because they've had losses that really aren't related to the work that you've done. And so you want some mechanism to be able to defend yourself. So one of the things that insurance brings with it is also legal defense. So the insurance company, if they're defending you for professional practices, then they're going to hire an attorney and pay for the attorney for you to ensure that you have a proper defense, as opposed to having to take the money out of your own pocket, even for frivolous claims. So we just want to be aware of that. And then of course we can cross the line and go from negligence into fraud. And that's a whole different environment, because the difference between negligence and fraud is that negligence is not intended, but fraud is. Fraud is an intentional act. So while negligence can be, there's really two elements of negligence. One is ordinary, which can and does happen, but the other is gross negligence, which is really a dereliction of duty, and that should not happen. But there's different liabilities attached to it. So even if it's gross negligence, you might have criminal liability. Not often, but you could. But generally speaking, negligence is going to come with it the potential for serious civil liability or serious money damages. When it comes to fraud, it's a whole different realm. You might have monetary damages attached to it, but you often also have criminal liability attached to it. So we just need to be aware that that because of the people understanding the and investing in companies and understanding the role of CPAs and the increased pressure being put on government regulators and the complexity and the litigious nature of our society, that it would be foolish to enter any profession without knowing what the risks are and how to mitigate them. So, and as I mentioned, and as we've talked about, there can be different types of things that go on. There can be audit failure, so you issue an incorrect opinion. There can be audit risk, which basically means that you fail to find a material misstatement. And then there can be other factors going on where people can assign blame to the auditor where it really doesn't belong. So when we think about, we think about negligence and liability. If you're following the prudent person concept, then you generally, if you follow the guidelines, you follow generally accepted accounting principles. You've reviewed them. You've followed generally accepted auditing standards, and done so as a prudent, a prudent person is a reasonably carefully person, then you're going to minimize your exposure for negligence. But it doesn't mean that doesn't mean that you'll never be charged, sometimes rightfully, sometimes not rightfully. But we have to recognize that this is the society that we're in. So there's ordinary negligence, there's gross negligence, and then there's fraud, right? So just be aware of that. The other thing that could come into play is contract law. If we don't fulfill the duties we have to our clients, then we could be sued under contract law as well. Okay, so most common source of lawsuit against CPA are from clients, but they can also be from third-party shareholders, people who invest in the company if you've done something that you've not performed up to standards. So, all right, don't want to get too much involved in the nuances, but yeah. And so the other thing to keep in mind is Sarbanes-Oxley has increased the standards and increased the barriers in terms of professional performance and professional obligations. So we just have to be aware of that. And these can be both civil and criminal. And criminal liability really is going to come into play if you're involved in a fraudulent, intentional act. But even if you've been grossly negligent, so if you've just been derelict of your duties, not followed the standards, not made what a reasonably prudent person would do, and then you issue a report, then it's always a question of, oh, I didn't know, as opposed to I knew, but so you just want to have to keep these things in mind. So the response, to this: seek protection from non-meritorious litigation, right? So again, professional liability insurance. Improve auditing to make better use of needs. So you want to continue to enhance your competence and make sure you have a quality control process in place. And also we have to educate users about the limits of auditing, right? So these are all things that we need to keep in mind. So so we'd like, one of the things we have to be careful about is making sure that our clients are ethical, right? Because if we end up with an unethical client, they could bring I shouldn't say frivolous, they could bring lawsuits that really shouldn't be brought, but still time and money to protect yourself. You need to hire qualified people, make sure that they're properly trained, make sure that they continue their professional education, need to follow professional standards, and you need to maintain your independence so you don't get caught into the slippery slope of where fraud can come into play. So deal only with clients possessing integrity, and that's easier said than done, but sometimes there are red flags, right? You want to keep your independence. You don't want to cross that line. Make sure you understand the client's business, and if you don't, you should walk away from it, right? So if somebody asks you to do an area that you have no expertise in, just walk away from it, because it's really not worth the risk. And then quality audits means that you are familiar with the standards, that you've kept up with the professional changes, and that you have qualified personnel. Make sure you do the documentation of your work. And then this idea of professional skepticism, which we're going to talk about in Chapter 6. So, and then carry adequate insurance. So this is really called professional liability insurance, and it's relatively inexpensive given the risk that any professional person has, particularly when you're dealing with investors who may have lost millions of dollars and sometimes more. You want to, as appropriate, seek legal counsel, and you also want to organize your business or be part of a business that has limited liability. So that means they're either a corporation or a limited liability corporation. You don't want to expose your personal assets through sole proprietorships or partnerships without some limited liability. Okay, so that's, I think, kind of summarizes everything we want to talk about in Chapter 5. Any questions before we move on to Chapter 6?
Nope.
All right, well, all right, thank you. So let's move on to Chapter 6, and oops. We'll talk about Chapter 6. going to start with the video. Then we're going to go to some Kahoot questions. So.
Responsibility for discovering material misstatement due to errors and fraud. In the prior session, just to remind you, we looked at management responsibility for the financial statements. So we talked about management responsibility in this session. So if you don't know what management responsibility, you can go back and review the prior session. In this session, we're going to look at the auditor's responsibility. So what's the auditor responsibility? The auditor has two responsibilities. Overall, two responsibilities. Again, this is right working from the literature, from the AICP auditing standard. The overall objective of the auditor in conducting an audit are to obtain reasonable assurance, not absolute assurance. We don't give anything absolute. Reasonable assurance whether the financial statement as a whole are free from material misstatement. We're going to talk about materiality due to fraud or error, thereby enabling the auditor to express an opinion on whether the financial statement present fairly in all material respect with the applicable financial reporting framework, GAAP. Okay, for example, GAAP. And report on the financial statement and communicate as required by the auditing standard and according with the auditor's finding. Then issue a report. So after we do this, B, issue a report. So basically, what are we saying? Well, we are saying we're going to be providing reasonable assurance about misstatement due to errors and fraud. So we're going to talk about each concept separately. We talked about material. We said material misstatement. So let's go ahead and talk about material versus immaterial. And I know we covered this a little bit in the past, but it's worth looking at it again. What is material? Material error or misstatement if the combined uncorrected error and fraud in the financial statements would likely have changed or influenced the decision of a reasonable person using the statement. So what does that mean? It means we didn't put a dollar amount on it. It's not quantifiable. All what we're saying is the error is material if it will change someone's opinion about the financial statement. Someone, we call it a reasonable person. So a reasonable person also is not really, we don't specify what a reasonable person is, and we don't put a dollar amount about materiality. It's not quantifiable. It might be quantifiable for one company, but that number could be different for other companies. So that's why we don't throw a number. It's unique and specific to each company. Not unique, it's specific to each company. Okay? So that's why we say material error. If there's material, it means what about immaterial errors and fraud? What is the responsibility of the immaterial error and fraud? Well, let me tell you something. There's going to be a lot of errors in the financial statements. Small errors, maybe. And who knows, maybe some fraud. And we're going to talk about what is fraud. What's the difference between error and fraud? That's also we have to define. But let's assume we know what they are, and we're dealing with immaterial. What's immaterial? Immaterial means it doesn't really have a huge effect on the financial statement. So it's not changing someone's opinion. So what's our responsibility? Well, it may be economically unpractical to find all material errors and fraud. So from a cost-benefit perspective, it's not worth looking for immaterial errors and fraud. We're going to have to spend more time. We're going to have to build a client. It may not be worth it. You might have to spend $1,000 to discover an error for $50. Well, it's not worth it. It's going to cost you $50, and the error to find this error is $50 and costing the company $1,000. It's not cost benefit. Okay. Regardless if the error is material or not, bear in mind that the auditor only provide reasonable assurance, as we said. And what's reasonable assurance? It means the auditor does not guarantee anything. Okay. No absolute assurance. Reasonable means to a great degree, not absolute or any guarantees. So the auditor don't give any guarantees. So even if we have a material error, the audit may fail to deduct the material error. So if we did not deduct immaterial, well, that's okay. It's not a big deal. Maybe it's not worth pursuing. But what happened if we not be able to deduct material error? This could happen. But you want to make sure the auditor does what? You want to make sure that the auditor followed auditing standard, followed the proper auditing standard. So that's the first line of defense for the auditor. I did what I'm supposed to do. And we're going to see later what does it mean I did what I'm supposed to do. I followed the auditing standard. We're going to talk about professional skepticism later. Did you maintain your professional skepticism during the audit? Did you collected sufficient appropriate evidence? Okay. Also, could be many reasons why a material misstatement could be missed. Why? We use sampling. We don't audit every single transaction. Okay. So in sampling, guess what's going to happen? When you sample, you're going to run the risk of uncovering a material misstatement because you are not covering 100% of the transactions, 100% of the balances. You're going to be sampling. Also, the nature, extent, and timing of these tests. What is that? Nature, extent, and timing, and the evaluation of the test result requires significant auditor judgment. Now we're going to be talking about the nature, extent, and timing. So basically nature and extent and timing. What are we auditing? When are we auditing it? And how much are we collecting of evidence? And we'll talk about this later on. And when we collect this evidence, we're going to have to make a judgment. And guess what? Every time you hear the word judgment, there's a room for error because you're making a judgment. There's an error. Also, there's complex estimates, which are inherently part of the financial statement. And those estimates are very complex. They may require a high degree of sophistication, like in an actuarial situation for a pension. So we're making estimates. Again, once you have estimates, there's room for errors as well. So also we could make an error or not uncover something because those estimates are complex in nature. Okay? So the auditor has to rely on evidence that's persuasive but not convincing. So sometimes we're just going to have to go with good enough evidence. It just sometimes the evidence that we need to collect cannot be 100%, cannot be convincing 100%. But as long as it's persuasive, we did our job, we did what we're supposed to. We maintain our professional skepticism, then we should be good. Okay. Also, why would we miss material? Why could we miss material errors or fraud? Collusion among management to commit fraud, especially fraud, not errors. Here we're talking about fraud. Collusion means what? Collusion means many people in the company, maybe 2-3 managers, they're colluding together, and by doing so, they can hide things from the auditor much better. Okay, why? Because they are colluding, they are agreeing with each other to do so. So it's going to be harder for the auditor because the purpose of a company is to have internal control. So one person checking on the other person, and that person maybe a third person here checking on those two. But when they're all working together to commit fraud, it's going to be very hard for the auditor to uncover fraud. So collusion could be an issue. Okay, and let's talk about the difference between errors versus fraud, because we've been throwing those two words. You know, material, we defined material, we defined reasonable assurance. What's the difference between errors versus fraud? Well, hopefully you know what an error is. An error is an unintentional misstatement of the financial statement, whereas a fraud is intentional. So error, you made basically a mistake on the financial statement. That's by mistake. That's basically what it is. By mistake. You did not do this error on purpose. Okay. For example, when you're counting inventory, you overlooked few items. So overlooked inventory during audit, not on purpose, just by mistake. You did not count those inventory by error. Fraud. And for fraud, we have two types of fraud. Basically, we have misappropriation of assets and we have a fraudulent financial reporting. And we need to differentiate between those two. Usually, misappropriation of asset. Misappropriation of asset is a fancy word for theft. Okay? So a fancy word for theft. Usually, not always, usually, see the word usually, committed by employees or low-level employees. For example, they may take some supplies with them home. They may steal inventory. It's misappropriation of asset. Versus fraudulent financial reporting. Fraudulent financial reporting is another type of fraud, which is, this is when you manipulate the financial statements. You manipulate the financial statements. You manipulate the financial statement. Usually, it's that is committed by management. Why? Because management, they have access to the record. They can make a decision about the financial statement. Okay. That's the difference between.
Hola amigo, do you want to learn to speak Spanish faster? ¿Quieres hablar mejor español? Maybe you've taken classes.
So what's the auditor responsibility? The auditor responsibility for detecting material errors? Well, the auditors spend a great portion of their time planning and performing the audit to detect unintentional errors. Basically, unintentional means fraud that are done by management and employees. So they do look for this, okay? But they can only provide reasonable assurance. They cannot provide any absolute assurance to detect materials, errors, and fraud, okay? So, what is the responsibility for detecting material fraud? Well, it makes no distinction between auditor responsibility for detecting fraud or errors, whatever material or not, okay? However, just keep in mind that fraud is more difficult to detect. Think about it. When someone commits a fraud, they will try to cover their tracks. They don't want anyone to find them on purpose. They will try to mislead you. So people who commit fraud, they will try to mislead you. They will try to confuse you. They will try to provide evidence that tells you otherwise. But when someone commits an error, guess what? They're not aware of it. So they don't attempt to hide it. Okay? So that's the difference between errors and fraud. And it's a little harder to detect fraud. Okay? Again, fraudulent financial reporting, which is who's usually committed by? It's usually committed by management versus misappropriation of asset. Both are harmful to the financial statement users. Of course, they're both, you're doing something wrong. You're doing something that's affecting negatively the owners of the company, the users of the financial statement. So the fraudulent financial reporting presents users with incorrect financial information. So you're giving them the wrong picture. You're not really telling them what's going on. Therefore, when they make their decision, they're not really informed. So you are defeating the whole purpose of the whole purpose of financial reporting. The whole purpose of financial reporting. Okay? Misappropriation of asset, simply put, again, a fancy word for theft, is harmful to creditors, stockholders.
Okay, we're going to go to, we're going to start going through the chapter itself, and we're going to look at some Kahoot exercises. That's just kind of a warm up to our discussion. So we're moving on to chapter 6. And chapter 6 deals with auditor responsibility. Audit responsibility. So please join me on the Kahoot game. Okay. Thank you. So this is chapter 6, audit responsibility and objectives. We'll probably get about a quarter of the way through it today, and we'll continue it on Friday. So section 1 talks about explaining the objectives of conducting an audit of financial statements and an audit of internal controls. So we'll ask a few questions and then we'll look at the slides. The objective of an audit of financial statement is an opinion on the accuracy of the financial statements. Okay, good. Yeah. So I'm sorry that. So the okay, so I'm going to show you why that's false in a second. The objective of an audit of is in all material respects. Okay, so little bit, I guess a little bit of a tricky question there. Yeah, so the objective of the financial statement of an audit is to express an opinion on the fairness of in all material respects. So we want to make sure there are no material misstatements and that management has complied with generally accepted accounting principles. If the auditor believes that the financial statements are not fairly stated or is unable to reach a conclusion, what should the auditor do? Yeah, so, we don't have an obligation to notify regulators under normal circumstances, but we certainly do have an obligation to notify the users of the financial statements through our audit report. So there may be times you would want to withdraw, but the primary thing is that if you do not believe the statements are fairly stated, or you're unable to reach a conclusion, then you're going to write either a qualified opinion, or you're going to write in perhaps an adverse opinion, or write it or indicate that you can't reach a conclusion based on the information that was available to you. So our obligation is to our clients and to the readers of the financial statements. Which of the following was not one of the steps used to develop audit objectives? Okay, yeah, so what is not one of the steps? So we'll look at the steps in a few moments, but when you think about doing an audit, you want to make sure that you look at the financial statements and you divide them into cycles, so you can look at each probably quarterly in the appropriate cycles. You absolutely have to have objectives. You have to understand the industry. You have to understand the business, understand how transactions are classified. Have to know the management assertions about the financial statements. But certainly one of the things is not to know the proper steps or the proper type of audit opinion. That's gonna be your conclusion after you've done these other things. So the purpose of an audit is to provide financial statement users with an opinion by the auditor on whether the financial statements are presented fairly in all material respects in accordance with applicable financial accounting framework. So, to state it the way I have throughout the semester, that management's complied with generally accepted accounting principles and there have been no material misstatements. And so you're providing, again, a reasonable opinion. You have a reasonable basis to believe that, not an absolute basis. So these are the steps to develop audit objectives. So understand what you're trying to accomplish. So if you're trying to accomplish that management's complied with GAAP and no material misstatements, that's certainly, then you want to divide the financial statement into cycles. So we can think about cycles as either the business cycle or the quarterly reports that they may issue. But if you think about the business cycles, there's the revenue cycle, there's the cost cycle, there's the inventory cycle. And then you want to know what management's assertions are about the financial statements. So because these are management statements, right? These are prepared by management They're owned by management. We're just here to attest that management's followed the rules and there's no material misstatements. So then know the audit objectives for all classes of transaction. So you basically need to know, what the general accepted accounting principles are, what the right audit procedures are, and then you can complete your field work, document your field work, and then review it with management, and then you can issue your opinion. So distinguish management's responsibility for the financial statements and internal controls from the auditor's responsibility for verifying the financial statements and effectiveness of internal controls. So the responsibility for adopting sound accounting policies and maintaining adequate internal control rests with rests with company management, not the board of directors and not the company's internal auditors. So this is owned by management, and you'll see that the CFO and the CEO sign basically saying that they've, particularly for publicly traded companies, accounting policies are being complied with. That's going to be true for all audited financial statements, and for larger publicly traded companies, that they're in compliance with Sarbanes-Oxley internal control requirements. If management insists on financial statement disclosure, the auditor finds it unacceptable, the auditor can do what? Yeah, so really any of the above is can be done. And generally speaking, auditors are not going to withdraw from an engagement, particularly over a difference of opinion. What's most likely to happen on a legitimate difference of opinion is a qualified opinion or an unqualified opinion with a statement in there about the differences and then quantifying the differences. If there's really a serious difference, then more likely an adverse opinion. But again, those are very seldom issued. So the qualified opinion is the most likely, but if in extreme cases, an adverse opinion or walking away from the engagement, are things that you have to consider. Sarbanes-Oxley requires both the CEO and CFO to certify the financial statements. Yep. Okay. So that came out of Sarbanes-Oxley. So prior to that, it was not a legal requirement, even though most CEOs and CFOs did sign the financial statements. It's a little higher barrier now. Management is not responsible for which of the following? Yeah, so if you think about what management is responsible for, so adopting sound accounting policies, right? And when you think about accounting policies, generally accepted accounting principles, what we have to recognize is that there's a difference between rules and principles are generally a little more broad and open to interpretation. And that's one of the things that we want management to adopt the right principles for their particular business and situation. And that typically is going to reside with the CFO, right? We don't expect the CEO or the engineering department to figure out the right accounting policies. We expect the CFO to, play a leadership role in that, and then maintaining an effective system of internal controls. And what that really means is that you have a whole set of guidelines in place around segregation of duties, approval levels, et cetera. And we'll talk about that as the semester goes on, the different types of internal controls in place. But it's management's responsibility to put those systems in place. And then what Sarbanes-Oxley requires management to do, which was never a requirement before, is to test those internal controls to make sure that they're actually functioning as management intends. And then to document that. Okay, so you put them in place, you test them, and then you document it that you've tested them. Those are all requirements. And then, you may find that as you test them, that some are not working as you expected. So the obligation is to then address that, come up with a countermeasure. And so you've done all that, and then the CPA firm comes in if you're under the Sarbanes-Oxley laws, and they'll attest that management has put them in place, tested them, and documented the results. The CPA firm does not put those in place. And then make fair representation about what the financial statements are. But the opinion obviously resides with the CPA firm. So management does not have the right or the responsibility to do that. So management responsibilities, financial statements done in accordance with generally accepted accounting principles, no material misstatements, implement internal controls, test them, document that you've tested them. Sarbanes-Oxley increases management's responsibility, right? So there's higher levels of responsibility and liability due to Sarbanes-Oxley. And the CEO and CFO must certify, right? So they must attest that they've reviewed them and they believe that that the financial statements are done in accordance with GAAP and no material misstatements. It doesn't mean that there aren't errors. Of course, there are errors, and it doesn't mean that that sometimes they'll go back and restate them, but that they've done due diligence, right? So so here's a statement that that could be issued, right? Responsibility for the integrity and objectivity of the financial statements presented in the annual report rests with IBM management, prepared in accordance with accounting principles generally accepted in the United States of America, applying certain estimates and judgments as required. IBM maintains an effective internal control structure, consistent part of organizational arrangements, clearly defined lines of responsibility and delegation, comprehensive systems of control procedures. Important element of control is an ongoing internal audit program. So this is the checking to make sure that management's internal controls are in place. Our system also contains self-monitoring, and actions are taken to correct deficiencies. And then they talk about the audit committee. This is for larger companies. The audit committee of the board is composed solely of independent, non-management directors and responsible for recommending, etc. Okay, and then signed by the CEO and the CFO. Okay, so the one thing that didn't exist before provides for criminal penalties for anyone knowingly falsifying these statements. So it ups the ante. Okay, so I think we'll break at that point, and when we pick up on Friday, we'll pick up on section 3 of chapter 6. Okay, so thank you for being here today, and I'll see you all Friday morning.
Have a good one, Professor.
Professor, I have
Thank
a
you.
question.
I'm sorry, is there a question?
Yes, I have one.
Yeah, please.
Is the quiz open yet or not
No.
open yet?
No, I've not created the quiz yet, so.
Okay, that's why I'm asking, because I got confused when I went into Blackboard.
Okay, very good.
Thank you so much.
Okay, thank you. Bye.